Hey, this is Elliot from Victory Charts. It is October 28th, the day of the Fed meeting, and so I just thought I'd make a video to answer an age-old question, I feel. So should you use trailing stops or just take those profits? And there's a few factors to consider here. There's psychological issues with this method. You have to prove to yourself that you can be consistent and worry about the money later. So I'll show you what I mean by that. So the psychological factors is when you get greedy, when you feel like the trade's about to take off and you're about to make a bunch of money, you'll probably want to trail your stop so you can lock in more profits. And so at some point you'll feel the greed coming, and the question you need to ask yourself is, can you sit through the pullbacks of that trade? So if you're up $600-700, can you sit through a $300 pullback and let the trade really work, or are you going to freak out and take profits, or move your stop to break even and then get stopped out of break even, which is usually what happens? So that's a question you need to ask yourself, is can you sit with the pullbacks? And also, what does the data say, which we'll take a look at in a bit here. So trading is all about confidence building. In the beginning, it's just you need to focus on the process and forget about what would have happened and what should have happened, and that's easier said than done, and I have a hard time with it also. So what I would recommend is just take your profits as they come and do not worry about what happens after. So if it goes on to move $1,000 more, it's fine. You followed your plan and you did what you needed to do, and that's it. Give yourself a pat on the back. And like I said, this is easier said than done, but it will pay off in the long run. And when you see that you're becoming consistent, then you can start to take on the harder psychological tasks of letting profits run. And this takes a lot of discipline. I mean, I still have a hard time with it, and it's one of those things that you just have to work on continuously. And the money will come later. And what I mean by this is, once you have that formula for success, all you have to do is scale your method. So what was once $200 to $300 a day will become $2,000 to $3,000 a day by just scaling your size. And so let me show you what I mean by showing you some data here. Alright, so here we have a breakout strategy. I actually wrote the code for this. It's a modified breakout strategy with time constraints on crude oil, and so it just takes breakouts at pivot points. And so what I have here is, you can see in the past 60 days it made $14,000, which is great, 60% and 42 average trade profit, which is pretty good. I mean, that's pretty solid. So what we'll do here is we'll show you the parameters. Whoops. Alright, so we're going to format just the exit criteria. We're going to leave the stop loss the same. Right now it has a $200 profit target. So instead of a profit target, we're going to do a trailing stop for those times when you feel greedy. So we'll do a $200 trailing stop, and now watch what happens to these numbers. So 14,000, and all of a sudden it gets cut in half. So it just shows that sometimes greed is not the best way to go, because you'll see here on this trade, okay, you caught a big portion of that trade, but on every other trade and the majority of the trades, you didn't make that killing that you were going for. And so that's just a way to show you that trailing stops usually are not the answer for one contract. Later, when you have size, you can get a little more flexible with your exit strategy, but for the most part, just a simple profit target will do the trick. So here's the $200 target again, $200 stop, that didn't change, nothing else changed. And we'll see on this trade we didn't catch the big move, but we'll see on every other trade we were a lot more consistent, and that's really what matters. So let me just show you. So here's the equity curve. Alright, that's an amazing equity curve, and I'll throw in the trail and we'll see what the equity curve does. So yeah, a lot more jagged, not as nice. I mean, you have the big moves during those really nice moves, but you have bigger drawdowns and you have a lot more chop. It's not very consistent. So it's just something to think about when you're trading and when you're putting together your trade plan. Hope you enjoyed this video. I'll see you next time.